Good day and welcome to the F-Word discussions where we look at news that's happening around the world. I'm joined by my co-hosts back in Pretoria, PJ, Ruvan. How are you guys? Doing well?
Great.
Doing well, thanks, Joe.
Great. And as always, we're going to look at a quote of the week. We're going to look at a chart of the week. And we're going to look at a question that we got through the week. Now, I'll quickly start us off with a quote. And my quote of the week is, "To know and not to do is not to know." Let me say that again. To know and not to do is not to know. And I think we see this so often. PJ, Ruman, we talk about, if we look at the fitness industry or health business, most of us know what to do. You should exercise regularly and you should eat less crap food. And you know what's crap food and you know what's healthy food. It's simple. Yet we don't do it. So we don't actually know. We can't say we know and then we're not applying it. And we see this in finance every day. PJ, Ruman, when we sit with clients, they know they should spend less. They know they should invest more. But yet they don't do it. We find it very seldomly that people invest 20% of their money, be patient, and keeping it for the long term. I think people always try to overcomplicate things. I know with the chart and the question of the week, you are going to go into more complicated things, but we need to start with the basics. We need to start with creating the right habits, the right mindset with money, and then we actually know. So if you don't do, you don't know. So my challenge for you this week is to apply that simple things in your financial area of, in your financial world, and make sure you don't overcomplicate it, because that is within your control. Your actions are entirely in your control, and you cannot blame anyone for that. That's my challenge of the week. Once again, that quote, "To know and not to do is not to know." That's it from me, gentlemen. Ruvan, you're going to go next. What do you have with us in terms of the chart of the week?
Okay, thank you, Joe. Just give me a second while I open my presentation. Can you see my presentation?
Yes.
Yes, there we go.
Perfect. So I just want to talk a little bit about the production of platinum, especially because it's quite a large portion of our exports, of the South African exports. So platinum is obviously used extensively for jewelry, but the main use is catalytic converters for cars, trucks, and buses, which you can see there at the bottom. This accounts for 50% of the demand of platinum. What is a catalytic converter? It reduces the CO2 emissions that comes out of an exhaust. So obviously the CO2 emissions are produced by burning fuel, and this reduces those emissions. Now, you'll see there that combustion vehicle sales is a big part of what the platinum will obviously be used for. You can see there in 2017, that was the peak for global sales in internal combustion engines. And then from there, you'll see it taper down, where plug-in hybrids and full battery electric cars have taken over. You can see that on the right as well. It's quite a big jump from 2017 to 2022 for plug-in hybrids and for battery powered electric cars. So I think the question is, what do we see as the forecast for platinum going forward? If you see there, that is specifically electric cars, the amount of sales, red being China, blue Europe, light blue United States, and then other. You'll see that there's quite a big growth in the sales of electric vehicles, and we might see that even growing further. I definitely see that happening. Now, what will happen now is you will see that South Africa accounts for 73% of the global production of platinum. This graph shows the production of platinum. The line there would be the current production or the current year of production. And you'll see that the forecast says that the production will increase So going forward, there will be an increase of production. We did, however, see that in 2022, there was a decrease in production coming out of South Africa. But they feel that there will be an increase. I'll show you now why there will be an increase. But this begs the question. The demand will it seems like the demand will decrease. So what will happen with the price? More production, less demand. That seems a little bit concerning in my opinion. If you look at South Africa, the producers, the bigger producers in South Africa, here are some of them: Anglo, Northam, Impala, and Sibanye. They are the major producers of platinum in South Africa. And when we speak about the production again, here is some of the major projects that's actually starting to get to an end. You see some of them are still in the feasibility stage, but some of them also in construction already. You'll see that a large portion of these mines are in Limpopo. And this obviously does mean that the projection of the platinum production will increase, but once again, an increase in production, but a decrease in demand. We'll see what will be the end in price and what that actually means for South Africa, as exports specifically in commodities is a major driver in our economy. So let's see what happens.
Ruben, thank you. Just to bring it back to my quote, it's great to know that, if you know that, but what do you do about it as an investor? Do you kind of avoid all platinum kind of producing mines?
No. I think it depends once again on the person itself. What are your own goals in terms of your investment horizon and your investment decisions and the amount of risk that you are able to take on? In a normal multi-asset balanced fund, there would probably be allocation towards so some asset managers in South Africa would have allocation towards these companies that produce and sell these commodities. But you as an investor, that's not really your job. Even as an advisor, that's not really your job. That's the asset manager's job. But we need to know what's going on. In the greater scheme of things, most investors tend to think that, people buy and sell and it's sort of a gamble in the short term. Now, the investor should only worry about the long term. Buying and selling assets is not part of the normal investor's portfolio. But leave these decisions, I think, for asset managers, and don't try and be a stock picker or go long on certain commodities. I know that there are investment managers that are currently long for platinum. We'll see how that pans out, especially like I said there with EV vehicles beginning to take a bigger part of annual global sales. We'll see how the demand probably decreases.
Yeah, and like you said, commodities go through a cycle, and it will definitely change as well, and it should be a long-term view. PJ, tell us what we don't know and what we should do about it. What's your question of the week that you got from a client?
Yeah, I think you both talked about cycles, and I think we all go through cycles. Commodity have a cycle, then you also have a saving cycle. And a lot of people, a lot of Gen Zs, especially in the US, they only saw prices going up in the US stock markets. They saw stock markets going up for 10 years, Bitcoin going up, and the end of 2021, everything's looking good. But people that's long in the market, people that's a bit older, know there's big corrections. And last year we saw that as well, especially in the US. And then a lot of people say, okay, why do I take this risk in the market, like with platinum? Because we know the price can go down, stocks can go down. So the question is, why don't I just put all my money into a money market account or at the bank? Because especially at this stage where we are, again, in a cycle, you get interest rate cycles as well. We're almost at the top. Last 20 years, we haven't seen interest rates this high, especially in the USA, but even in South Africa, you get a very high interest rate for no risk. And the risk is a difficult word because risk, how we measured investments is how much price can go up and down, let's say in 1 month. So we know platinum stocks or something, there's the demand that can decrease in 1 month by 10%. While a money market, well, do that. We know each month you get that interest, and that's why people like that. It's almost addictive, that monthly interest they see on their bank statement that goes in, or they see just, especially the older people, and with big lump sum money, you get R1,000,000 and you see that interest every month just go in. Again, the risk is because you know every month what you're going to get. Might be a risk that the bank might lose the money and stuff like that, but no one thinks about that. We normally, when we think about risk, we just only think returns. And the question is, should I invest all my money or should I invest in the money market? And like all the other questions we have, the answer is it depends. It depends on what is your financial goal. If your financial goal is to buy a house in 3 months or 6 months, definitely put money into the money market, because you don't want to put 100,000 rand and now the stocks fall 10% and you only have 90,000 rand. Then it's safer to put it into money market. But if you want to retire, or in 30 years, you shouldn't put all your money into money market, because history, again, it cycles. Interest rates are high now, but history tells us you will do better in share price, even with that volatility 10% down, but next month it's 20% up. In the long run, you will be better off. So again, first question is look at your goals. Answer, I think for most answers, look at your goals, and that depends. And then another thing a lot of people forget when they invest in a money market is the tax implications. And we see it especially with high net worth clients. They've got a few million and they just park it into their bank account because they want to be safe. And then you get that nice interest each month. But in the end of the year, the tax man comes and say, okay, I see you earned a lot of interest, and you can't hide it because they even give all the information to SARS, and they say, okay, you earned a lot of interest, but it's in our interest as well to take some of that. So we're going to take 30-40%, depends on your tax tables. And that's seen as income, while a growth in the stock market is seen as capital gains. So you get only tax in an individual, you only get like tax on 40% of that gain, while in interest you get taxed 100%. So it's very important to look at the tax on your interests, and you have to look at your gain after all deductions, because that's what you want, after fees, after taxes, and that's a yield that you have at the end of the day.
Vijay, that's such an important point, and I think people really misunderstand it or don't understand it. The banks, they might advertise that you're getting a 10% return, but you need to look at your net effective rate, or what is your real rate of return after your taxes, because like you just mentioned, 100% of the interest you earn will go to your taxes or taxable income. So they don't look at that. And I think that's such an important point. They think they're going to earn 10% with the bank. It's a no-brainer versus the market volatility. Definitely don't want to take that. But that tax implication is very, very important. And I think that's where an advisor really shows his worth, be able to assist people with that, because it's not as straightforward as it looks.
Yeah, and there's other structures you can use as well that gets taxed less. Let's say a 5-year endowment, you can get taxed less. Again, the advisor can look at your tax situation, what funds can invest, and you can get actually a higher yield for taking no more risk. You can actually get a higher yield after taxes and returns.
Thank you. We're not going to get into that, but there's also the retirement annuity. A lot of people have slammed the retirement annuity, but they forget about the multiple tax advantages of that. Maybe we'll touch on that next week, as how valuable a retirement annuity can actually be for long-term growth. Gentlemen, thank you. I appreciate the time. We will chat next week and see what's happening around the world.
Thank you. Cheers.
Yes.